welcome back to Money Talks with Mia. I'm Mia Lee, escort, stripper, CPA, and recovered banker. Every week, we'll talk about a new money topic that's going to steer you toward financial independence and wealth building. Today, we're starting with the basics of investing. I'm going to start out by explaining what a brokerage account is and how to open one. You can't just take money that's sitting in your checking account, buy stocks and bonds and index funds with it. You have to open what's called a brokerage account. Now, you could do this through a broker like a Fidelity or a Vanguard or a Betterment or a Robinhood, or you can just do it directly through your banks. Let's say you have a Chase account, you can just open a Chase brokerage account. Both are good options, brokerage account or investing through your bank. There are nuanced differences between the two. For this example, we're just going to stick with the simple choice, which is just to open it through your bank. So now you have a brokerage account. You now have to move money from your checking or savings account into that brokerage account in order to buy securities. I want to talk about the different kinds of things that you can buy with an investment account or a brokerage account, starting with the safest to the most risky. Some of those are not going to be encompassed within the brokerage account of public securities because those are going to be the most risky investments like real estate and private companies. We're actually going to start with the safest options, going to the most risky depending on your short and long-term goals with your money and your savings. Let's put some examples to this. Let's say it's going to take you about a year to find the perfect car, perfect Birkin bag, Chanel bag, or whatever it is. You know that you want that money to sit for a year and you're going to use it in a year. For something like that, you probably want to just put that money into a high yield savings account, not a brokerage account. Meaning find one of these high yield savings accounts that's paying 4 to 5%, put your money in there. And the reason I say that is because you're going to access that money pretty quickly. You don't want to risk buying stocks or bonds or something that could decrease in value because you know you're going to use that money in a year to buy a car or buy a bag or whatever it may be. The reason I am recommending high yield savings accounts in this specific example, not only will you need the money in a year and you want to park it somewhere safe, the Federal Reserve is setting interest rates very high. So banks will pay interest on high yield savings account indexed to what the Fed interest rate is. The Federal Reserve sets interest rates based on what they want inflation to be. If inflation is high, interest rates are going to be high because they want to bring inflation down. We are currently in a high interest environment, which is why you see savings accounts paying you 4 or 5%. It's not because banks are a charity. It's simply the market prevailing rate of interest payments right now. Let's take this example into something a little bit longer term. Let's say you want to buy a house in the next 3 years. You might want to consider, especially in this high interest rate environment, something like a certificate of deposit or a CD. CDs are similar to savings accounts, except that you're locking in a fixed interest rate. In this example, you want to buy a house, you need to save toward your down payment for the house. You might be better off buying a CD versus putting it into a high yield savings account because a high yield savings account, that interest rate can move based on market interest rate. Let's say interest rates are 4 or 5% today, but they might go down to 2% 2 years from now when inflation comes down. Whereas if you lock in a CD, you can buy a CD of any term from 1 month to 10 years. Let's say you buy a 3-year CD, you know you're going to use this money to buy a house in 3 years. And in the current interest environment, you can lock in that CD for say 5.5% because we're in a high interest environment. 1 year from now, if inflation goes down and the federal interest rate goes down, that CD is still paying you 5% or 5.5% or whatever the set interest rate is on that CD because it's a fixed interest rate. This is an extremely safe investment that you can use for your short to fixed term savings goals if you know when you're going to need that money. Normally, I don't like CDs because interest rates on them tend to be very low, but right now, because we're in a high inflation, high interest rate environment, locking in a 3-year CD for money that you know you're going to use in 3 years is probably not such a bad idea. So I want to talk a little bit more about long-term savings for your retirement, for your life, for your future. This is where I really talk up index funds. I'm going to explain in a bit what index funds are, but I want to contextualize this in the example of saving for your retirement. I'll use myself as an example. I'm 35 years old. I'm probably going to work another 30 years and retire when I'm 65. I'm actually a workaholic, so I might never retire, but let's just say I'm going to retire at 65 because that is a normal retirement age that a lot of people retire at. That means that the money that I put into my retirement savings has 30 years to grow. Now, I have more than half of my net worth invested in index funds. Index funds are called index funds because they are a basket of stocks that are indexed to a certain either category of investments like consumer goods or telecoms or technologies, or they're indexed to an entire stock index like the S&P, the Russell 2000. Index funds have much lower fees than mutual funds because mutual funds are managed by an active investment manager, which means there's a person sitting at a computer picking stocks. And index funds just track, for instance, the entire S&P if you buy an S&P index fund, or every single publicly traded consumer goods company that is on the stock market if you buy a consumer goods index fund. And the reason why I like these passively managed funds is because they have such low expenses. They're essentially automated in their management. You're only paying fees and administration expenses for the seller of that security, which is typically some kind of financial institution, a Morgan Stanley or a Vanguard, something like that, for them to just pick up every single stock in that index. If you buy an S&P index fund from Vanguard, you're only paying de minimis expenses for Vanguard to buy every single stock in the S&P for you and a bunch of other investors. You get something called diversification. You buy an individual stock, say Apple. That stock is going to go up and down as it will. Apple, while it's a strong company, might go bankrupt or it might go 10x. And you don't know which way it's going to go. There's a lot of concentration risk if you put all of your money into Apple stock. Alternatively, if you buy the entire basket of information security stocks, you're also buying Microsoft and IBM and whatever, throw in some infotech stocks in there. So now you're buying, say, 50 stocks that are information technology companies as opposed to just Apple. You have diversified your risk because the chances that all of those companies will do extremely poorly is much lower. You're going to see a much more measured or even return. If we talk about the Standard & Poor's 500, that's an entire index of stocks. Historically, over the last 30 years, the S&P has returned 9.862%. That means that if you take a 30-year average of every single stock in the S&P, if you had bought every single stock in the S&P and held it for 30 years, you would have made on average 9.862%. That doesn't mean you're making 9.862% every year. You might be up 20% one year, down 30% another year, up 2%, and then down 1%. But it means that if you leave that money in there for 30 years, chances are, while past returns do not predict future returns, the S&P returned 10% a year for the last 30 years, it's probably going to return 10% a year for the next 30 years. By diversifying across the entire Standard & Poor's 500 basket of stocks, you're diversifying your risk as opposed to holding just one stock or picking your own stocks or picking a few stocks. You're most likely to make that average 9.862% return. And if you put it into an index fund, you're not paying an investment manager to pick individual stocks and then losing out on that 9.86% return against investment management fees and expenses that you're paying that investment manager because you're only paying for the administration costs of exposure to that broader stock market index. Within the finance industry, we have this joke that Vanguard basically works pro bono. And it's kind of true. So Vanguard is comprised primarily of index funds. They have a few mutual funds and actively managed funds, but the mission of the company is really to give retail investors, meaning you and I, access to broader markets via index funds. And because they have such large index funds and they're passively managed, their fees and expenses are so low that they essentially round to zero, which is why we have this joke in the finance industry that Vanguard works pro bono. I have over 50% of my net worth in Vanguard index funds. And I also buy what are called Admiral shares. If you buy 50,000 at a time, you get what are called Admiral shares. And the fees and expenses on the Admiral shares are even lower than non-Admiral shares because the administrative cost of them selling blocks of 50 at a time is lower than if they sold 1,000 at a time. I'm a huge fan of index funds. I'm happy to share in a future episode what exactly I'm holding. This is not investment advice. It's simply for informational purposes, but I have no secrets about how much I love index funds. And I'm super happy to share what I'm holding. Currently, off the top of my head, I have the Vanguard Admiral shares small cap and mid cap index funds. I have an MSCI one, which is European. And I have a few others that are sector specific. I have a consumer goods one. This is where I park half of my retirement savings just because you can set it and forget it. You don't have to look at it more than once a year. I look at mine every 6 months, every once a year. And I only look at it to rebalance, meaning if one index fund has performed well versus another one, I might now have, say, $150,000 in one index fund, but I only have $110,000 in the other one. I would put more money into the one that has $110,000 because I want equal exposure across all of my index funds. And that's the only reason I really look at the balances because I'm not touching this money until I'm like 65, maybe. Finally, I want to talk about more risky and illiquid investments. A lot of people have asked me about real estate, and I have very mixed feelings about real estate. Real estate is a very illiquid asset, meaning you can't just buy it one day and sell it 5 days later. You would lose a lot of money on the transaction costs. Who's to say you even have the ability to sell? If we think back to the subprime mortgage crisis, a lot of people bought houses that they then couldn't sell. You might buy something in the middle of a real estate bubble and then have that bubble crash. Or you might buy something at the beginning of a real estate bubble and have that really balloon and make a lot of money. But there's no guarantee either way. And while there's no guarantee that we put money in the market and it'll make money and not lose money, you have a lot more liquidity in buying an index fund than you do in buying an investment property. That's my 2 cents on real estate and illiquid investments. Please drop me your questions, comments, and suggestions for future episodes. Thank you for listening.